Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for what's today, Wednesday, March 12th, 2025. It is 11:26 a.m. Eastern Time. So I'm starting the video. Do a quick one. Start on the equity markets. Time permitting, I'll highlight some of the other things I'm watching and trading now. As I mentioned a couple times this week, I've been in quasi-vacation mode, meaning. I'm here. I'm not going anywhere. I do that a couple times a year. I'll take real vacation, travel out of the state or out of the country, and then usually once or twice doing that, and then just sometimes like for example, kids are home from spring break this week. Wife's taking vacation because of that, and so spending some time with them. So it was a comment, and I addressed that. You can check that out in the comment section. Yeah, Randy, you tend to do that when the market moves. I don't take a lot of vacations. I'm here. I love what I do. I'm in front of my desk, and then half the times when I am. Last time I was out of the country was last year in Italy, and I made a point right at the when there was some great trades to be made. We shorted Nvidia, did some other things there. And I got those out to you, the big stuff. When I see a big move, I always travel with a minimum my phone, not a laptop. So just want to let you know, I'm a one-man show, and probably take less vacation than most folks, and that's it. So this week, like I said, I'll be in front of my desk as much as I can. But I can tell you, in the next week or two, markets volatility's up. This is the time to make money. I agree. If I could, didn't have anything else going on. Told you I was out Monday afternoon. Told you I'd be out yesterday afternoon. Turned out I was out the whole day. Monday was a pre-op. I had to do a procedure yesterday. Scheduled for the afternoon. They called me in the morning, short notice. The hospital's 2 hours away, in the doctor's office I'm going to. So it's quite the drive. It's a whole better part of over half a day. And so I have one more procedure coming up. Hopefully that'll be the last, and maybe a couple follow-ups. So I'm gonna, the next couple week or two, there'll be some down days or half days. But as always, I'll, here's where I'm going. I always do my best. I work hard to have this not be a hindsight analysis kind of site. I use the example too. If you have a subscription to the Wall Street Journal, you have a team of a lot of people working there to get out content. And at any given point, some are on vacation, and most are working. But they're also giving you the news, what happened yesterday or what happened today in the stock market. No predictive value. Sometimes people write articles. And where I'm going with this is, I've been the trading plan that's in play right now, and everything I've been talking about for many months, looking for a major top in the market. And if you go back, if you're new to the site, you've heard this say many times that I tried to explain, and I many times over tried to explain to you how, for those that just can't see my aggressive targets, can't see those playing out, how I can call a top on a stock like Nvidia that everybody loves, not an analyst out there doesn't like, it's only going higher. How I can call tops in such drastic drops on stocks like that is because the charts, first and foremost, tell me where things are going. And then what I always say in these videos, how these longer term targets are going to play out, is that I promised you the news flow will change when the technicals start to play out. So first you got this. We got the sell signals. Remember, we broke from the trading range. Today I'm looking at the headlines, and now I'm seeing, was it one of the major banks putting the recession odds suddenly up to 40%? And I spoke to that as early as the beginning of this year, just a couple months ago, a few weeks back. The recession odds for this year were, mostly across the board, near zero. Very few, if any, analysts calling for recession this year, maybe a slowdown later in the year, maybe recession next year. And I said, no, we'll see the recession this year because the charts are going to go down, and the consumer confidence is 2/3 of GDP. It's simple. So if you want to know how, Randy, if most analysts say, no, we're record low employment, which I also address, how are we going to do this if, everybody, they're marching out on CNBC telling us, including Powell, the economy's on solid footing. So again, the Fed has a history of being just dead wrong, missing the turn, being reactive, not proactive, as do the majority of economists. So Anyway, and now where I'm going to is that, so the plan, if I shut down for 2 weeks, 3 weeks, the plan, the longer term, I always try to speak to active traders and then typical swing and trend traders, even 401k investors. And so the plan has been laid out, the long-term plan, repeatedly before it even started to, come to fruition. Recognizing the divergent high, talking about the trading ranges, clearly stating not only what would happen if we broke in which direction. If we broke to the upside, it would most likely fail. Then we'll do that. And we had that marginal new high, and predicted that when that happens, and once it fails, it would most likely be a quick swoon down to the bottom and then through down below. That's my experience in a trading range. You get that one last whipsaw to the upside. S&P made a little bit higher marginal high, and said this thing was long in the tooth, ready to break down. And so again, the trading plan was laid out there, and that was the first, well, on the 60-minute chart when we fell back below the green line, that was kind of the all-in moment where I said that would solidify the failed breakdown. And then at that, we just off the heels of what I call a long-term trend or swing short. I harped on that as one of my favorite trades. The bearish engulfing candles on QQQ and other indexes and so many key stocks, with one of the most simple and effective trading strategies. Again, trading on a weekly chart, we're talking swing trend 401k traders, because that is the potential to be a top. Now, right now it's just a correction. This is nothing more than a correction, and we can go up, and then I'm wrong. But even if you don't lower stops, which I believe you should at this point if you took that trade to protect profits, even if you just let it go, then you're still talking a minuscule loss if you shorted that bearish engulfing, because the stop on that trade was above there. Now, since then, we went on, as covered many times over, to break down below the trading range, which I said, the next clear breakdown would most likely determine the next trend that we come out of, the multi-month trend. And that breakdown's been to the downside. And, nothing goes straight down forever. Rubber bands get stretched, where, as I've highlighted in the last couple of days, the most first oversold reading in the last over a year. Oversold, and then before that, you got to come all the way back to right here, and then shortly after that, the bottom was in. So, again, I caution, especially because I believe this oversold reading is different from these two. These were oversold readings in a bull trend that had more upside to go. In a bull market, oversold is typically very fleeting, usually one and done. You kiss that level, and if you didn't step in and buy, it's not too late to get in, if you get in early enough, but you missed the turn. And we certainly caught it right there. That was our August 5th hard cover all shorts, go hard long for, what was expected to be a double-digit plus bounce. And we were oversold. We hit the 200 days. We got the bounce. Now, based on all that's happened in the last few weeks, months, sell signal after sell signal, starting out on the 60-minute charts, and then the bearish weekend bearish engulfing candles on the weekly, then the failure back down into and then below the trading range, the takeout of the 200s. There's a lot of evidence, and there's still no guarantees. And so again, the trading plan is just that. It's if you're a long-term investor, it may not be. I'll tell you, the time that I usually say to take 401k monies out, completely out of the market and or short, I like to see the 20-month moving averages get taken out. This is my monthly chart. You have this primary bull market uptrend line off the 2009 lows. This is really one big super secular, will go down in history as one of the big, biggest bull markets in history, extremely juiced, overstimulated by the Fed with, excessive, persistent, keeping the pedal in the metal with zero interest rate policies and all that good stuff. So when this trend line goes, that means we've ended a secular bull market. There's been corrections, and cyclical bears along the way, and we're most likely looking at deeper targets, deeper than those I gave you before. But again, nothing goes down forever. And then this 20-month moving average, you can see it works well on SPY as well. The S&P 500. Let me turn off all the lines. This one, if you look at this dotted blue line, again, it's a 20-period moving average on a monthly chart. I've talked about it. It's one of my better longer term. I call it like a 401k trend indicator. It's you buy pullbacks to it in a bull trend, and you will milk almost every penny of a bull market. Once you cross, and again, it's a monthly chart. Once you get the monthly close below, you exit and or short, and then you short rallies back to it, and then you captured almost all of that tremendously profitable bear market off the 2000 dot-com bubble highs. Then you regained them right here, and you milk every bit of that, or almost all of that bull market with impunity, and it gave you all these entry or add-on points on the pullbacks, and then boom, that one candle took it out, and that was the great financial crisis. 55+% drop in both the S&P and the NASDAQ, and it told you right here that candle right there, get out. So again, these are kind of my point is, this is a trading plan that will, until it stops working, and this has worked for decades. That's it. There's your candle. Get out of the market. If you missed it, say, darn, I wanted to short it. I missed it. Nope, you were given a gift on a kickback and a back test, and then that weekly failure closed right on it, and then another rejection, and you did catch almost the entire bear market right there. And then things changed back in here. Go back. You recovered the line. There was a 1 month candle. Even if you took the whipsaw and you got short again, you got back in. It told you to get back in right there the following month. And since then, again, don't look at the skinny parts. And don't even look at the fat part. Look where the candle closed. Green candle closed there, red. These were all closes, the perfect tests. Intra-month breaks only to close back on that 20-month. And the only whipsaw I see here, we had a COVID. Again, COVID was over before you knew it. The following month, we regained it. And then we had that Q4 of 18. Following month, we regained it. And that was a bear market, so it was below it and traded below it several months and then took it back right there. So again, I'm giving you long-term trend indicators that, you could, if you want, cancel your subscription now. If that's a concern, then take vacation and be out when I want to be out, spend time with family. That's the life of a trader. That's why I did it. And as I said in that comment reply, trader burnout and fatigue is a very real thing. I know I'm obsessed. This is my passion. I do this website it's not my primary source of income. I haven't ever raised fees, charges when everyone else was doing it in COVID. I do this because I love it. And it even helps me. This is kind of a diary by going over these charts, looking at charts, getting them out to you, trade ideas. It helps my trading. And so that's it. But you have these plans, and let me just jump back to that, because yes, plans change all the time. I will, pivot on being bullish or bearish on something longer term, sometimes call a trade in early. Let me just show you right now what would really start to make me second guess if we're going to hit, before going to new highs again, if we're going to hit those longer term targets on the weekly chart here, T3, 4, 5, 6, and 7, right? Well, go back to this daily chart. As you know, we're very oversold. I'm leaning towards a bounce, position that way, plan to add more on a break of this uptrend line. That's your buy signal. No breakout, no buy signal. The 200s have already been jogged once. We had that first little hurrah off them when we hit them right here. But as I said before, I think the other day, what was last week or earlier this week, I said maybe a 6-7% bounce. Could be as much as an 8 now. I gave you bounce targets today on NQ and all that. If we pop that, there'll be undoubtedly quite a bit of short covering, and my guess is we'll probably come. It would be too easy. Now, we could do it, but when all eyes are watching the same levels, thinking the same thing. So rally back your 200 days. That's a very logical but almost too obvious target. And often when you slice through them, you go through them again to the upside. The bottom of the trading range, certainly an objective level to cover close longs if you're gaming a bounce, add back shorts. Or look, we had some powerful sell signals. Let me repeat that again. We have pretty much a lot of evidence. We had the potential when those bearish engulfings were printed back a few weeks ago. Again, it was on the weekly chart, not here on the daily. It was right here. and then subsequent evidence, what I call check marks. So it is kind of, especially if you're not an active trader, picking up nickels in front of a steamroller. So as a long-term swing and trend trader, you may just want to sit tight. At most, maybe if you don't have your fill of shorts or you're lightened up a little bit, if you do get the kickback, add back on. And the reason I'm not talking about shorting here is the same thing I said a few days ago. The RR, risk to reward ratio, is not worth it. I think we could certainly break. That rubber band can break, as I talked about. There's a lot of people who use the analogy, you stretch a rubber band far enough, it's going to snap back. And that's often what happens during strong corrections. But every now and then, it's very rare, but every decade or so, the band breaks. And those are called market crashes, where the market, quote unquote, should bounce. But due to various factors, including but not limited to excessive stop loss orders on longs being hit, excessive margin, which is what you always have towards the tail end of a bull market. Most folks are loaded up on Bitcoin and Nvidia and the stocks du jour on margin, and so those get hit pretty hard. And you see that in the big names, Nvidia, SMCI stocks that we've shorted recently, and we've played on the long side in the last year or so quite a bit as well. PLTR is a great example of a crowd favorite, overloved, overowned stock. Bearish engulfing candle there, and the stock fell 40%. Most of that happened in just a matter of a couple of weeks. Yeah, that's a crowded rush for that, and it's a bearish chart. But you're going to see people coming in that wanted to own this, buy it here, but just couldn't pony up. It had just not let them in. I still maintain that's probably an exhaustion gap with a continuation gap there and a breakaway gap there. You can look those terms up. And I can tell you those are, this is definitely an uptrend line that was broken, back tested, and we're below it. So now if we bounce with the market, where to? Back test the trend line. You can see I have a horizontal, there's that gap. That's why I had that level right there, 98.95. So that's a very logical bounce target. People will want back in these stocks once they think it's safe to get back in the market. And I think it's safe to say bearishness has ramped up quite a bit lately. And most are blaming Trump largely on this whole thing. He's, erratic, the whole, the uncertainty about these tariffs on and off, on today, off tomorrow, spatting, no Ukraine aid today, Ukraine aid tomorrow, that kind of thing. And I said it before, the markets don't like uncertainty, but he's just one or two tweets away from, saying something the market loves, and it could explode to the upside or again, crash. My thoughts are, he hasn't, we know this. He used to always talk every day. He was talking about the stock market and saying how great it was and how great he was in his first term. And they say he's been unusually quiet. He knew the market would probably take some pain, but it's getting to the point now where, I would guess. And look, if we get the rally and it's going to be technical induced, I've said this many times. If you think you're going to trade successfully off following Trump's Twitter feed, X, whatever you call it now, and following the headlines on, on the news, good luck with that. You're trading on hindsight information. Even if the market moves right when you get it, you miss most of the move. You do you, but I do me, and that's the technicals first and foremost. They're not perfect, but they're infinitely better than trying to trade. Because news is fundamentals, guys, by the way. And there's not a trader in the world that trades on fundamentals. Warren Buffett, investors trade on fundamentals. Warren Buffett's known as one of the greatest. He'll buy a position if he plans to sit on it 5-10 years, and he will go deeply underwater and add to it because his time horizon's so long. But there's not a single active trader or swing trader in the world that I know of that could trade off headlines, fundamentals. Look how many stocks blew earnings away last quarter, and I predicted they'd go down after. And it's very common that a lot of stocks top on great record earnings and on all that. So if you would have bought those earnings beats a few weeks back, you would have been clobbered on a lot of those big tech stocks. All right, so that's that. There's a plan. There's a trend line. Be careful, as I said. Volatility's high. There's no evidence of any type of bottom yet, but there is, volume looks a little capitulatory lately. And look, I still have, at the end of the day, got to be careful. Divergences I often talk about can get burned through. I'm talking about the near-term bullish divergences on the intraday charts. If I'm correct and we're going from point A down to all the way down to point 0.7, T7, so 52% drop in the NASDAQ 100. There's still a lot of downside potential, and as I talked about, I'm sort of leaning. We already hit T1 and T2 back here. They're just continuations of these are the targets I laid out back here when I figured we'd probably peak around this level. We made a marginal, slightly new high. We could come down quite a bit before we have a much larger counter trend rally. The one now I've extended, it's probably going to be about, if my bounce targets are hit, what I say, probably about, let's just say we go to the bottom of the trading range there where I have it marked on this one. I might have it a little lower on the daily chart. Yeah, it's about a 7% bounce. IWM, I shared that today. I really like that one. Get longer term bearish. Look at that nice bullish falling wedge downtrend line. Let me tighten that up a little there. Pop that. And again, when I give you max targets, that's just what that is. I will assess the charts as we go. But we get a breakout. You could have took it at support. I gave you those levels, those charts. That was the last screenshotted chart I had, was back from late December. You could see these same levels. That was blocked by my annotations, but the line was there, and that's that 199.70 target I had. We hit it 2 days ago. Intraday pierce down through. Hit it yesterday. Intraday pierce. Kissed it at the lows today, and we're moving off it. And this, I really, small caps. If we hit my trend line there, that's going to give you, if you took it today on the support level, where I got it out to you, that's where I took my starter. I will add on a breakout. That's going to be given, if and when we hit it. Remember, trend lines are dynamic. They come in at lower and lower price points every day. You have a price support level there, really good. So I might, depending on how things look, if I'm still in it, sell right there, shy of that 214.90 level. That's a 7.5% pop to that 214.90 level, which, depending on, again, if and when we get there, because trend lines being dynamic. If you went straight up today, it'd be a bigger move. If it zigzags up like this, it could, take a little bit longer. I love bear markets because I love them for two reasons. Number one, stocks fall a lot faster than they rise. I say that often. Therefore, that's one of my reasons I love shorting stocks just as much as I love going long. But I also love, even if it's just a correction, call it a bear market correction, only time will tell if it's the start of a new bear market. But they also rise faster in a bear market during the bear market corrections. If you were trading with us back in 2022, we gamed with near impunity the two big counter rallies that we had in this bear market. We were long off those lows based on all the things there, positive divergence, 60-minute charts, daily charts, rallied up. I barely see my annotations. It was a 17% bounce. We caught nearly all of it, reversed there, got back in short, and then gamed that one too, 24% bounce. And these are in just a week or so. You're talking gains that beat the average return, long-term annual return by far of the indexes, and you can make that in weeks. And so if you successfully navigate a bear market down, or a bull market up for that matter, and you just sidestep, this is what swing trading is all about. And you either sidestep the counter trend rallies, if you're long, meaning sidestep the corrections, or if you're short, sidestep the rallies, or even better, well, why not? If you have a high degree of confidence, good enough, and you pick an objective entry and you quantify your losses with stops where you shouldn't violate. In other words, if you're buying, the reason you buy there is you're at support, oversold with positive divergence, then your stop loss will be a little south of the support level. And it's that easy. So nothing ventured, nothing gained. Yes, believe me, we don't bat 1,000. I don't bat 1,000, but there are times where, batting close to 800 or so, and there's sometimes I can't get out of my own way if it's the market or whatever security I'm trading, and then sooner I recognize that and either adjust my trading strategy or get out of it, then the better. So I just want to point out where we are, still looking for a decent bounce, and more importantly, as I've been saying the last few days, it's if you didn't short or yet, and you want to, I wouldn't short here if I were you. We could crash, the rubber band can break, but the risk to reward is not worth it. Now, if you do, you can, and then you just set your stops accordingly. Where would you, if you want to short now? Let's say, because as I often say, one thing I do, I identify the key support and resistance levels that are important. In other words, likely to trigger a breakout or rejection. So if you think this market's not ready to mount a 6-7% bounce yet, and it's going to go down more, which is very well could. I'm not sold on anything. Then what you do is it's objective to short on this bounce back to this. This is the downtrend line that has been capping all advances since the high right here. And it's TA 101. You short that, a rally back in a bear trend, you short a rally back to resistance. Hard stop. That's it. It's that simple. You don't overthink it. However, I do process a little more. I will short rallies back to resistance all day long until the point I think, based on my analysis, that resistance level is more likely to break and then trigger a long. So in that case, I'm not going to short it. I'm going to wait for the breakout. I currently have longs, but I'll look to add to longs. And again, you have my bounce targets. What else do I have for you? Nat gas, told you we hit. That was just been a monster trade for me this year. And last year it was all. We hit that 490 target I've been calling for since last year. Really right off the lows. So we milked the entire trend almost penny to penny on natural gas. Now, here's where we're at. I just wanted to update you because I told you it's an objective level to close that long and turn around and short it, and that's what I did right here. We're coming up on a potential uptrend line. Why did I call it potential? Well, there's only 2 reactions so far. In my book, it takes a third confirming, but there's also price support. You know what? Oh, sometimes these charts don't. There it is. So boom, there it is. It's hit right there. So that is, I'm just giving it to you live right now. So we're at an objective level to cover. If you shorted and reversed there, you added another almost 15% profit to that 90+% gain. Again, the 90 plus, I point out ins and outs. There's been a trend of zigzagging up with plenty of divergent highs, corrections. But again, I expect a more of a trend reversal. I'm still open to, as I said in that other post, that after more than that, we'll probably come down here, minimum maybe here. Then I'll take a look at the charts and see if the likelihood of us going up to that even next higher potential target I gave you. So the way it works now is whether we bounce here or not, which I'm leaning towards a reaction first. And if and when we break this it's 415 price support right there, the horizontal line and or this intersecting trend line, then that opens the door to the next support level there. And then there. And that's a nice trend line and price support in there. So that would be another potential area to cover short and reverse. So there's natural gas for you UNG folks that don't trade futures. As I've always said along this trade, this is where we're buying it down here, buying it at support, divergent lows. So, it's a ETN that does its best to track. So it's underperformed natural gas. Oh, yeah, 92%, not too bad. And remember, was it pre-market? I believe the highs were in pre-market when I highlighted that too. No, I'm sorry, Sunday evening. So you're not going to see it on the daily chart. You're not going to see it in UNG, which is, again, I've said this many times, one of many reasons I trade futures. Tax benefits is a huge one. The taxation of futures contracts, Section 1256 contracts. Also the fact that there's virtual on the main stuff, not obscure things like, orange juice futures, but everything else, the indexes and natural gas and crude oil, liquid around the clock. And so you can use stop loss orders, or in the case of UNG, you don't see me post many Sunday evening posts, but I saw it open up, got an alert, boom, my order was filled. Got out. We were at resistance right at my 490 target to I think it was 489. I always tell you I set my sell limit orders a little bit below resistance level I'm targeting. And so this one, when we hit T8, I said align your best. All along in this trade, I said best to align your UNG targets with those on NG. So that's it. And there's that uptrend line that we're at, comparable on NG. And so you can see if and when that goes. And also, by the way, guys, I would have never reversed just because that target was hit, but we also had nice, as I pointed out, negative divergence. And so, I think they'll probably be in the coming weeks more downside. How far? Minimum probably right here, and maximum there. And if we do power up and keep on break out, remember, if we break much above $495, that does then open the door, especially if we burn through the divergences, we can go to that longer term target I gave you on the futures. Let me just wrap up here with Bitcoin. We've been short Bitcoin since back there on that bearish rising wedge break. I had S1, which meant first support. That's what I'll do when a support level's not deep enough, in my opinion, to be considered a first price target. And but it means it's a significant support level that needs to be taken out to increase T1. So we hit it. As I covered, I kept giving you updates on this. Hit it. It took a while, just like the stock market, because it trades in line with the stock market. It's not random coincidence. You have an almost identical trading range I just circled here that you had on QQQ and SPY. And so we kept bouncing off my first support, first support, and then boom, we took it out in one fell swoop, hit my first target. And then I gave you an update there that, and then we hit my second target, rally back. I gave you an objective short add-on or re-entry if you cover that T2 right there. I gave you a range before it was hit, the top of the gap right there, shorting range. We hit the top of the range, and so, from wherever, just that last short, we just hit T3 and a trend line. I covered this one the other day. That alone was a 17% drop. And then T3 is intersecting uptrend line and price support. It was this gap right here, and that's around $44. And that's it. Now, I still maintain these targets. I still think we're going there. It's just a matter of, we're going to do this first. There's a similar uptrend line to IWM, also a risk on, index. Maximum bounce target, also very objective if we get there. And if the market decides not to rally now and there's just a lot more sellers wanting out, it's simple. I wouldn't short it right now. I'd wait for a break of T3. I'd wait for the indexes to break support, and then we'll hit these targets. But this is what I favor right now. It should go without saying, but it bears repeating, that if I think the NASDAQ, tech, which is one of the king of risk on indexes, the NASDAQ and the small caps are going to bounce, and it stands to reason Bitcoin's going to bounce. And if they don't, then they don't. Just remember, it's a correlated trade. You're just going to make more money in the same dollar amount. But on the flip side, you should have less into Bitcoin. I call that beta adjusted position sizing. It's just like if you're trading gold or GDX. GDX is going to move up or down in a multiple of gold. And so if your number, whatever your number is, whether it's 1,000 or 100,000 or $1 million in position, you're going to have 100,000 gold. But you might only want to put 50, 60,000 in GDX if you decide to use GDX in lieu of, because of that, it's going to move up and down more, whatever your number is, depends on the time. All right, guys, so there's your update. That's still think the odds are pretty good for a bounce. It could be explosive. We could just be a single tweet or headline away from an explosive short covering rally. I think the market's kind of had its fill of bad news. Unless nukes started flying, I can't see anything else that's going to come out of Trump's mouth or anything else. On there's always the economic calendar, but I'd have to check on that. I've been kind of detached a little. I usually check it day to day. I think today we came in with the CPI was benign, so that helps support the case for rally. If we had a hot CPI, it would further reduce the chance of rate cuts. And by the way, you want to know what Powell's going to do? Just follow the market. If I don't want to call him. Let me just hold my tongue here. I don't have the highest regards for that. I just think they don't know what they're doing, and they're actually detrimental, I believe, longer term for the economy and the markets. But with that being said, I think Powell's smart enough to know wipes out the wealth effect and risks, especially if this continues down. So you will see rate cuts. The Fed has never, ever hesitated to come in and step in and cut rates solely to stop prevent the stock market going down. They are smart enough to know, even though they don't often get it right, they do know that the stock market is the leading driver of consumer confidence and wealth. And so, and again, consumer spending being, roughly 70% of GDP, If the stock market goes down X, and you're high flyers. Remember, it's not just about the indexes. A lot of folks towards the end of a frothy, strong, seemingly bulletproof bull market tend to, get rid of. Well, I used to be a stockbroker years ago. I remember back in the dot-com bubble, I had clients coming to me, would come in, and I had a diversified portfolio, a lot of blue chip stocks, and then some with aggressive stuff and small caps and tech. And they insisted we move everything over, much against my advice, and because they're dang small caps and the techs. We had UITs back then; they didn't even have ETFs. So it was a predecessor. I'm kind of dating myself now. Unit Investment Trust. They were up, some of them 400 or 500% in the year, and this is 1999. And so my point is, I know consumer psychology. And so I know, and just talking to people, friends and acquaintances, that people have been. They want to buy SMCI here, they want to buy Bitcoin and MicroStrategy here, and load up on that stuff right at the top at the exact wrong time. And I'll just give you an update on the MicroStrategy trade. Why I'm here. This is a current trade. Where is it? Where's my targets? Oh, daily chart. That's it, guys. So there's a downtrend line, potential bounce target. It's been holding the 200-day moving averages. Remember this trade we shorted right after that bearish engulfing candle there, which so far marked the high. I think it's safe to say that was a top because it's dropped 57%. We hit our second target here, bounce hit that trend line. So there's the trend line to watch. And if something else is going on, we pop the trend line that's going to be near-term bullish. Then T1 would be your next resistance level, my firmer for. Oh no, T1 was a trend line. I'm sorry, but that's price level there. But if we do get a rally back in this one, personally, I favor Bitcoin over this to game a bounce. But that'd be from where we're at right now, still another 18%. Remember, I've been looking for this bounce the last couple of days, so it's already up. That'd be about a 23% rally to just back test the trend line, and it would be an objective short entry if everything else lines up. If it's we have an all clear to get back short on the markets, and that's it. Just looking for a little bit of a bounce in the equity markets, and if I don't get it, then I just wait for the next objective entry, long or short. But again, I just think the risk reward right now is not favorable to adding or taking new shorts if you don't already have a pretty existing short position with some embedded gains. Okay, so that's my thoughts on the markets. I don't want to get too much off on a tangent here. Somebody asked about you can check the last. I got back to some the questions from yesterday. There was an update on wheat, things like that. I still and always do favor running a diversified portfolio. Diversification, you must understand what that means. Diversified portfolio with 10 stocks may or may not be diversified. If you have Apple, Amazon, Microsoft, Nvidia, and QQQ, you're not diversified at all. Farthest thing, and even add Bitcoin to that. Bitcoin is a completely unrelated asset. It's its own really asset class, if you will, crypto. But if it's moving with, which it often does, and is currently with the stock market, you might as well, have just more QQQ. So diversified portfolio will be different stocks within different sectors, long and short. Long the most bullish, short the most bearish. Various commodities, be it in whatever looks good at the time, long or short, agricultural commodities, industrial commodities, energy commodities, natural gas, crude oil, stuff like that. Bonds when the time is right. You guys know me, and we've had we've batted probably 800 or 900 on our bond trades this year. Right now, I'm just standing aside. I don't see me. I'll talk on something day after day and engage it actively, long, short. And then there's times I step back. And here's TLT. It's at support. But if the market's going to bounce, it's probably going to come down more as you see a relief from that flight to a safety bid. And plus, there was a little divergent high recently that like I said, I don't have a position right now or strong conviction in bonds. But as always, feel free to ask me, bump me for an update on anything I've covered in the past or anything I haven't covered. If you want some my thoughts, my 2 cents on something, if I have an opinion, I'll give it to you. And if I don't have an opinion, I'll tell you I don't have a strong opinion. So just post that in the comments section. Okie doke. That's it. I should be here most of the day today, and like I said, I'll be here most of this week. I just have maybe one other thing to do, and that pulls me away from the desk. And then if I do any family stuff, but that's it. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.